Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alpha and Omega Semiconductor Limited quarterly report. Alpha and Omega Semiconductor Limited offers a wide range of businesses and services that cater to various industries. The company's primary focus is on designing, developing, and supplying power semiconductor products for computing, consumer electronics, communication, and industrial applications. The company provides several types of power discrete products, including MOSFETs, IGBTs, and application-specific MOSFETs for use in various devices such as smartphones, notebooks, servers, data centers, base stations, TVS, AC adapters, power supplies, motor control systems, e-vehicles, white goods, and industrial motor drives. In addition to discrete products, the company also offers power ICs that deliver power and regulate power management variables. These power ICs are used in devices such as flat panel displays, TVS, notebooks, graphic cards, servers, AI data centers, DVD/Blu-ray players, set-top boxes, and networking equipment. Furthermore, Alpha and Omega Semiconductor Limited provides other products and services including transient voltage protection products, analog switches, electromagnetic interference filters, silicon carbide, IPM, TVS, HV gate drivers, power modules, multiphase controllers, ES-buck regulators, and diode protection switches. These products cater to various industries and applications, making the company a comprehensive provider of semiconductor solutions. The stock price of Alpha and Omega Semiconductor Limited, AOSL, has plummeted by approximately 48% over the past year due to a series of unfortunate events and financial challenges. One of the key factors contributing to this decline was the analyst downgrade from B. Riley Securities in November 2025, which lowered the company's stock price target from $40 to $24. The disappointing fiscal cone 2026 results and weak QTWO 2026 forecast further exacerbated the situation. The compute segment, a crucial area for AOSL, experienced lower sales due to an AI driver push-out and reduced volume. This indicated delays in the adoption or production ramp-up of AI-specific components or systems that AOSL was expected to supply. The company's gross margin expectations were also missed, and it reported negative earnings per share, EPS, raising concerns about its financial health. The recent fiscal QTWO 2026 loss of $13.3 million further highlighted the challenges faced by AOSL. Additionally, the decline in net cash position due to operational outflows and inventory digestion has put pressure on the company's cash flow. The combination of these factors has led to a challenging period for Alpha and Omega Semiconductor Limited, resulting in a significant drop in its stock price over the last year. Alpha and Omega Semiconductor Limited market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $27 billion. Alpha and Omega Semiconductor Limited trades at a lower price-to-book ratio of 0.81 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 20% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key drivers include the introduction of new products, expansion of product portfolios, diversification of services, strategic partnerships, and joint ventures. These initiatives have contributed to significant increases in sales, such as the $24.9 million rise in power IC products and $1.8 million increase in packaging and testing services. On the other hand, revenue decline drivers are more complex and varied. Decreases in PC market demand, erosion of average selling prices, manufacturing costs, and capacity availability have all contributed to revenue declines. Additionally, changes in distributor ordering patterns, customer demand fluctuations, seasonality, and rate of new product introduction have also impacted revenue. Furthermore, specific market segments such as consumer markets, home appliances, gaming products, power supply and industrial markets, power tools, quick chargers, and communication market battery products have experienced declines. These factors highlight the dynamic nature of the industry and the need for companies to adapt quickly to changing market conditions. The net income of the company experienced a significant decline in both the 3 and 6 months periods of 2025. Compared to $5.4 million in the third quarter of 2024 and $11 million in the first half of 2024, the net income decreased to nil in both periods of 2025. This substantial drop in net income is a cause for concern. The profit margins also underwent a decline, with gross margin decreasing by 1.3 percentage points to 22.5% in the 6 months period and 1.6 percentage points to 21.5% in the 3 months period of 2025. The reasons behind these changes are attributed to various factors, such as the decline in PC market, which could have a material adverse effect on revenue and results of operations. Additionally, gross margin may be adversely affected by manufacturing costs, capacity utilization, wafer capacity constraints, and erosion/fluctuation of average selling prices. The decrease in net income and profit margins is a clear indication that the company is facing significant challenges in its operations. The decline in PC market and other factors mentioned are likely to have a lasting impact on the company's financial performance unless addressed promptly. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the net cash provided by operating activities for 2025 stands at a substantial $23,100,000. This is a clear indication that the company is generating positive operating cash flow, which is a crucial metric for any business's financial health. The presence of a positive amount in this category suggests that the company's operations are profitable and capable of producing sufficient cash to meet its obligations. The company's financial health has shown a positive trend in terms of its debt levels and interest expenses. The total debt decreased significantly from $211,971 to $183,525, indicating a reduction of approximately $28,446. This decrease is largely attributed to the decline in long-term debt, which fell from $14,872 to $2,113, and short-term debt, which dropped from $11,852 to $2,980. Furthermore, the company's interest expenses have also decreased substantially. For 2025, interest expenses were recorded at -$154,000, a significant drop from the previous year's -$701,000. Additionally, for the 6 months ended 2025, interest expenses stood at -$514,000, down from -$1,513,000 in 2024. These reductions indicate that the company is better equipped to manage its debt and associated interest costs, which should have a positive impact on its overall financial performance. Management is optimistic about the company's outlook, citing several key strategies to drive growth. One major focus area is expanding the product portfolio through the introduction of new silicon and packaging platforms. This move aims to increase the serviceable available market (SAM) and offer higher performance products, ultimately improving financial performance. In addition to expanding its product offerings, the company plans to diversify its portfolio by leveraging its expertise in technology, design, and advanced manufacturing and packaging. This will enable the company to optimize product performance and cost, further enhancing its competitiveness. The breadth of the product portfolio is seen as crucial for business prospects, providing opportunities to increase total bill of materials within an electronic system and address power requirements of additional systems. To support these efforts, management continues to invest in developing new technologies and products, while exercising cost control measures to reduce selling, general, and administrative expenses. Concerns about inventory buildup and supply chain disruption are evident in the recent data. The company's accrued inventory has seen a significant increase from $1,465,000 to $1,098,000 between December 2025 and June 2025, indicating potential issues with managing stock levels. Furthermore, there are signs of supply chain disruptions on the horizon. Wafer capacity constraints at third-party foundries may hinder the company's ability to meet customer demand, posing a significant risk to its operations. Additionally, a decrease in accounts payable of $8.5 million suggests that payment terms with suppliers may be changing, or that potential issues within the supply chain are emerging. The increase in inventory purchases by $22.4 million also raises concerns about the company's ability to manage its stock levels effectively. This could lead to further accumulation of inventory, exacerbating existing problems, and potentially straining relationships with suppliers. Overall, these indicators suggest that the company is facing significant challenges in managing its inventory and supply chain, which may have far-reaching consequences for its operations and profitability. That concludes the financial summary for Alpha and Omega Semiconductor Limited. Feel free to comment below, and I will be happy to answer them when possible.